All right, let's get the show on the road. So it's going to be saved anyways for anyone else that's missing it. So just from last week's call, we're going to push this more, right? We want to push more of the IUL content and the IUL training because just as a recap, IUL products has the highest persistency in the company. It has a 92% persistency. And the reason why is when you overfund it and when you do it right, clients are going to be paying 20, 30 to 200, $300 a month into the policy. It's super, super big. And in two, when you overfund it, they're going to already have cash value into the policy. So if you got a client that missed a couple of payments, it can already do an automatic premium loan. And then they can just put it back in place by paying 1 month to put it back, and they don't have to catch up because there's cash value extra in it. But typically now you're dealing with some clients that have income, they are looking at this as a retirement form, or they're looking at this as a builder for someone else, for their kids or their family members, right? So this is why we want to push this, because you literally can sell this to anyone, and there's agencies, IMOs out there that works without leads, and this is the only thing they're selling. So if we can tap into that type of market, you guys can do the same thing. Everyone knows somebody that can be sold to. So who are the clients? Dude, you can sell anyone. From kids, young kids, age 0. I'm going to show you a policy for my kid that I started, all the way up to 70 plus if they're really healthy. Okay, so when it comes down to the senior market, though, it's going to be considered like a fully underwritten application. You can still get it up to 60-ish with certain carriers without a physical exam, but typically over 100,000. 60 plus, they got to pass the physical now. It's going to be fully underwritten, but now you're going to get a better death benefit, a higher death benefit, higher premium on it. And it's permanent compared to like a final expense senior program. So I've been explaining this to some of my leads. The easiest way I kind of found it to make sense as far as pricing to them, when I explain the final expense product versus a regular product, I just differentiate it by saying, okay, so we have what's called a senior product. So this is specifically for seniors. It's a lenient underwriting, doesn't require any physical exam. You can get cancer, you can have heart attacks, you can have, diabetes, you've had strokes before, and you can still get approved. It's just a lenient underwriting. So we have a better product for it. We call it our senior product. But because you're getting qualified, the prices are higher. Then we have these standard products. This is the standard life insurance where average working class members can get, but you have to be really healthy. Now, to get this, you got to be healthy, but you're going to get a better rate. Okay, you're going to get a cheaper rate. So when you differentiate the two, if they can qualify, you can put them on a Mutual of Omaha IUL-E. You can put them on Ethos IUL. You can put them on FNG. You can put them on LNLG. But just differentiate. How come this one price and this one company is higher versus the other? Well, we got a senior plan and we got a regular plan. Okay, based on you and your medication, we either got to put you on the senior plan or we can get you a better rate. Okay, so next, the type of IULs out there. There's the simplicity of like the Easy Solve with Mutual of Omaha or Ethos. You can play around with it, but really the Ethos and the Mutual of Omaha, they're meant as a death benefit option. So what I mean by that is you're using the IUL and you're selling it like a permanent life insurance, but you're getting a better rate because it's a cheaper rate than a whole life, right? It uses the cash value to kind of help out with the cost of insurance in reality, and it plays in the market. So soon enough, if your cost of insurance does go higher, there's cash value to offset it. So that's why it's important to making sure it's correctly created. The Easy Solve with Mutual of Omaha, you can't go wrong with it. It's going to last forever. They've done it enough pricing on it, and it's one of the most, I would say, it's the first thing that put everyone in notice when Mutual of Omaha came out. All these other carriers are trying to copy it now. Okay, so Americo, Prosperity, they're coming up with IUL plans because everyone's been selling the Mutual of Omaha IUL-E. So that's more used as a death benefit option. The second option would be a cash accumulation option. This is where you're overfunding the application. You're overfunding the policy. So the best companies out there is to use FNG and NLG. Okay, and then let me go through a couple of scenarios for each one. So if you're dealing with like a final expense client and you think you can get them a bigger plan, or they want a bigger plan, that's where you want to go Mutual of Omaha. Okay, Mutual of Omaha IULE doesn't require an illustration. If you do an easy solve, just do the app, boom, it'll create an illustration for them as well. But just understand, it's built as a death benefit. So you're not playing with the allocations, you're not playing with the interest. It's built as their default. Between age 60 and under, 59 and under, 40 to 59, you can get up to 250,000. Younger individuals can get up to 300,000, 18 and 50-ish. But key factor on this, and why this is Mutual of Omaha is one of the top IULs out there. It's simplified, no physical exam, no blood and urine, and you can go all the way to age 75. So if you got a client in their 70s, they're really healthy, just barely blood pressure, like cholesterol meds, you can get them approved, and you're gonna blow out the rates from a $10,000 plan, $20,000 final expense plan. You can beat them with this because now you can sell between 25,000 all the way up to 150,000. So how I say it to my clients, between that senior plan and the standard plan, this is how I say it. I say, okay, look, we can get you the senior product. The greatest thing about this, it's meant for final expense. So we have plans that we can sell you like 3,000 to 5,000 minimum face amount. Now, if you want to get the standard plan to get the better rate, you're going to get a great, think of it like wholesale pricing, like the Costco discount, but you need the warehouse pricing of a minimum in bulk. You got to buy it in bulk. So with this plan, you need a minimum of $25,000 of coverage. So how I explain it then is, okay, so if we can get you the Mutual of Omaha IUL Express, I don't say that full name, I'm saying it for trading, but if we can get you this standard plan, the minimum is $25,000. It's $100. But if you do the regular senior plan, you can't get below 25,000. So if you're only looking for 20,000, we got to put you on a senior plan. The senior plan is $130 a month. So they'll see the difference. But if you want to do 5,000, go with this. So they're either going to take the lower one, but if they're in the middle of 2025, boom, you can sell a Mutual of Omaha IUL Express all day. And if they're really healthy, 70 plus, it's good. So little issue with the underwriting on that. They're kind of hit and miss. Okay, so they go, most insurance companies, if they're simplified issue, they go through two things. They do IntelliScript and they do MIB. And they don't go off of that. Okay, they don't go off like sideways from that, meaning that there's no gray area. If there's an issue, if it's on the IntelliScript, if it's on the MIB, you got to fix it. Like us got to fix it. I've had two that have gotten fixed, but it takes a while. It takes like 2 to 3 months. So if there's an issue where it's thrown off, sometimes I switch it back to FNG. That's when I would sell FNG. But sometimes now you'll end up having a risk of having a physical exam. And because it's not as key as a death benefit versus accumulation, sometimes it's going to be a little bit more. So doing an FNG takes like 2 weeks plus to get an application approved, right? So the simplicity with Mutual of Omaha, man, and it's only 10% off your comp. You could do an application, submit it just like a final expense, and get paid on the next day, the next 2 days. So that's the best part for it. Okay, so that's a couple of things with Mutual of Omaha. Up to 75, no physical exam, but the underwriting, they got to be really healthy. They got to be decent. So actually it's the same underwriting. It's the same underwriting as the Term Life Express. The GOL, Term Life Express, and IULE share the same underwriting and share the same face amount maximum coverage, which is up to 300,000. So just think of selling this like you're thinking of selling a term with a return of premium, or think of selling a CBO. You can't sell that term product to someone unhealthy. They won't fly, right? So if you're running through some clients, who's a possible client, if you run into a 40 to 75 that might have like an arrest history, might have diabetes. Diabetes is actually a cool thing with Mutual of Omaha IULE. if it's over 50, if they had diabetes over 50 and they're not on insulin, or even on insulin, they can get approved. We can still get them approved on this. And so you can get them a better rate. So sometimes you get some diabetic clients, you know, they're making good money, they're still working, but they want more than 30,000, 40,000. You can throw in a Hail Mary for Mutual of Omaha IULE. Just understand though, I've made some mistakes with it where I pushed the better product, I pushed the better premium, and they didn't get approved. And it's harder to go back because now you got to put them back on the senior plan, and the senior plan costs more. And now I shot myself in the foot and I lost the sale because I tried to get him a better 25,000 plan. So hit and miss. So play your options. All right. Next, NLG. Really, we like using NLG for their term, but with their underwriting, they're the only company that can go up to 2 million without a physical exam on their term and on their IUL, right? Ethos and FNG, they can go up to 1 million without a physical exam on the IUL, right? So if you're doing bigger plans, NLG has a lot of great things. FNG and NLG both have living benefits. Mutual of Omaha kind of has a chronic illness rider living benefit, but full living benefits, NLG and FNG. NLG even has living benefits on their term policies. Okay. Quick rundown on that. If you guys don't know what living benefits are, they're critical illness, chronic illness, terminal illness. Think of it like if you got a car accident and you got banged up, you need an adjuster. And then when you have an adjuster, they look at all the things that they can pay out based on the damage. So same thing. So chronic illness, if you're chronically ill, you can't perform 2 out of the 6 daily living activities. You can't feed yourself, bathe yourself, in and out of chair, medication, take a shower, those type of things. They'll adjust and give you a payout out of your death benefit. Critical illness, same thing. If you had a heart attack, stroke, cancer, something that was critically ill, they'll pay that out of your death benefit. And in terminal illness, you have less than 12 months to live, they'll pay some on your death benefit. Okay, so that's what the critical illness and chronic illness living benefits work. So NLG going back up to 2 mil, right? Up to $2 million. They have great plans where if you guys know of business owners, they got LLCs, they got key business. You could do what's called key business insurance with them. Okay, so it's called key business. It's a tax write-off. So essentially what they're doing is, if this is where you can find some big money, you're able to create the IUL, tell the business owner, the CEO, or whoever owns the business, let's say there's multiple partners, they could have it where the business is paying for their IUL, and then they can use it as a pension plan. They can use it as a retirement plan. Okay, so first it protects the business in case the individual dies. The beneficiaries, the business, right? So it's key person. But if in case they don't die, let's say they put in their 20, 30 years and it's well funded, they can now take ownership of the business, or I'm sorry, of the IUL, and they'll do a lifetime income on it. And now that'll be their pension. So if you guys know some people that are making a lot of good money, they don't have a game plan on how to make money outside of the business. Now you can tell them, look, you have an exit plan, you have a lifetime retirement, you have a track on this using the business. So whether the good business is good, I mean, you find some people, they're they're in some dispensaries, they're in some construction, lawn mowing. It's all like service based, right? But if they're self-employed, there's not a lot of options for them to build up besides a Roth IRA. These are great opportunities. So if you guys ever need like help on it, we can always call the carrier. I can help you guys out on how to do the illustrations with it. Then let me talk about FNG. FNG compared to NLG, I would use them more. First off, because of the commissions. FNG product is cheaper. I mean, it's less subtraction out of your comp. It's only 10% off your comp, just like Mutual of Omaha IULE. The difference is once you start doing illustrations with NLG and FNG, it's typically off of your target premium. Okay, let me explain what target premium is. Compared to Mutual of Omaha, since it's set up as a death benefit, most of the premium, if not all of it, is going to be commissionable. What's not commissionable is any extra premiums paid to build cash value. So when you start building cash accumulation type products, let's say I set up a plan for $100 and my cost of insurance is only $30, and then the rest of the money is $70 is going into cash value. My target premium is $30. Target premium is $360 a year, and that's what you're getting paid 10% off your comp for. So when we start talking about illustrations, we want to make sure we illustrate it correctly. I'm going to now go into illustrations. Any questions so far? I'm going slow, but I'm going fast because I'm just trying to cover main topics. So far, so good, right? I haven't lost anyone.
I had a question about
Sure.
if you don't mind. I had a question because I have a client that's she has like she does a lot of marijuana in California, so so she can't get like big time coverage. But I was wondering, they have a juvenile policy for F&G, right?
Yeah, I'm about to
Is
show
that
you my kids.
okay? Because I wanted to know if the minimum is like 25K for kids, or is there a minimum for kids? Because I know Mutual of Omaha is 100,000. I was wondering if F&G had a minimum.
Yeah, 50,000.
Okay.
Yeah. So here's one for my kid. It's FNG. So FNG has two main products. There's really three, but you only need to focus about two. So going back to the two types of policies, right? We either have a death benefit or a cash accumulation. So with FNG, their cash accumulation product is called Path Setter, and then their death benefit one is called Everlast. So just understand the name Everlast. It sounds like it's going to die. Everlast, that's the death benefit one. Path Setter, you're building something. So this is the cash builder. Okay. So I set it up. I pushed it to the lowest minimum level. So typically when you want to do a cash accumulation, the lower the death benefit and more premium, the rest of the money goes to the cash value. So I set it up where I'm paying $100 a month. I lower the death benefit as low as I can, and it still pushed it up to 62,000 because this is max funded already. It's max funding the $100. Now, if I scroll all the way down, I mean, it is my kid. I'm not trying to make commission off of me. It's control business either way, so I'm not getting paid on this, and it's for my own policy. So I don't care about the death benefit, right? I don't care about the target premium because I'm not going to get paid. But imagine now you'll see it right here on the bottom. The target premium on this is $279.47, but the premium is $1,200 a year. So this is less than $30 for that death benefit, and everything else is going to the cash value, right? So you're not gonna, if you don't do it right, or if you don't do a good balance, you're not gonna get paid well on it. So there's ways to like play around where it's a half and half, and I'm gonna show you that. We got extra time, but here's an example. Three things when it comes down to illustrations. There's a guaranteed and two non-guaranteeds. Okay. Guaranteed means, and it has to be given and explained by law, by illustration standards, that what is guaranteed? Well, nothing's guaranteed because it's supposed to play in the market. So what they'll tell you is that the guarantees are zero, or in FNG's case, there's a guarantee of 0.25 end of the year. So that means that if this is invested in the index and there's no gains on the index, their guarantee per year that of no gain is 0.25. So out of the $1,200 premium I paid, can you guys see this okay? $866 builds cash value. So almost 2/3 or 3/4 builds up the cash value for it. And this is where it continues to grow. Now, when it comes down to illustrations as well, you can set it up to increasing. So this is like their ways. It's an increasing death benefit, but I have it switching to a level plan in 35 years. You can illustrate it however way you want. In this example, I figured I'm going to pay for this policy for 35 years until my kid is grown, and then I'm going to have her start taking money out on 35 years. You could do it later. Typically, you want to do it for retirement, but I'm thinking, okay, what would happen if she's in her 30s now, and then she can use some extra money, well, where she can pay some bills, she can pay a car, she can pay a mortgage with it, however she sets up, but she's going to get a lifetime income of that money every year for it. So I have it set up $1,200 a year. Cash value continues to grow. Let me explain the non-guaranteeds. Non-guaranteed first illustration is a small 4.75% interest. So this is just going to illustrate a 4.75% per year. And this one's going to illustrate a 7.3, the current one. Okay. Now cap rates, just to be technical, they can go from 8%, 12%, 15%, depending on the market. That'll be the cap. So if the market does 20% and your cap is at 12, you're going to get 12 out of this. Okay. So then you'll have your floor. This is your floor, and then the max on the index. It'll be up here actually. Cap spread 12%, 9%, 9, 3. This one 0% cap. So some have 0% cap, but usually they don't grow as much. Okay. So those are cap rates of how the market's indexed. So I'm just gonna scroll down to age 35. Okay. So I did this before the baby turned 1. So I got her locked in at age 0. I'm going to stop making payments from age 0 till 35. So I'm going to total put in 42,000 into this policy. And in that 35, I'm going to start withdrawing. I'm going to start taking cash value out of the withdrawals out of the cash value every year. And I wanted to do it until she's basically 65, until she retires. So this is going to give her basically, I put in 42,000, but I'm going to get out 408,000, and she'll still have a death benefit if everything goes well. So ideally at 35, she'll only have 150,000 cash value in 376. But even still at 150,000, she can still take out 13,000 every year forever until she's 65. And then I had it stopped, so that way there's still some death benefit on it. So at that point, there's still going to be a death benefit, 210,000, a small 6,000 cash value left. Okay. So now if she didn't touch anything, there would be $1 million in this. Okay. 900,000, 989. And that's only up from $100 a month plan. So you start talking to clients that want to put a little bit more money into it. They're able to do $200, $300 a month. They're going to grow. And so you just got to make sure that for clients that do want to get big policies on the kids, they just got to have double the coverage. So you can't have $1 million policy on your young kid and you have 0. It looks funny on the insurance industry. They're going to be like, why are you trying to kill your kid? Why do you not have a policy, but they got $1 million, right? So there's a red flag. They also ask how many policies are on each kid. Why is there just one on one individual versus 5 kids? You're gonna take one out, keep the others. So little underwriting concerns. Here's one I just did. Got a couple more minutes. My client just got approved. He didn't tell me he smoked, or he doesn't smoke, but he takes patches, so he got approved as a smoker rate. So I had to redo an application for him yesterday. He's 23. He got rated. He's a little chunky, but we got him approved. He's actually a lot chunky. I put a little bit of weight down and he still got rated. So, which is good. He's approved. Age 23, locked in with a table 3 table rating. I raised the death benefit of 150,000, premium of 150 a month. But the way I did this, I had it where it's an even higher death benefit. So it increases the target premium. It leaves some life insurance for him and his fiance. And I'm going to get paid more on it because it's not a max funded compared to other policies. Where'd he go? I'm just trying to find the target premium. It's missing. It's supposed to be down here. There it is. So this is a decent pay because annual premium on this is 150 times 12 is 1,800, but it's a 1,700 target premium. And it's a good mix because if I lowered it at a 23-year-old, he's only going to have $50,000 of life insurance. It doesn't do him too much. It doesn't save him money, or it doesn't give him a death benefit. But what I did, instead of doing an increasing, I had the death benefit as level so that the cost of life insurance stays the same, but the cash value builds up faster. So I got it set up. It's going to pay into him. He's going to pay till 65. At 65, he'll have 245,000. You can illustrate it if you wish. I just chose not to. I just showed him what the cash value will be. If he starts taking withdrawals on this any given point in time, he has 245,000 in cash value. He's only put in 75,600, and he has 300,000 death benefit. And sooner or later, he's actually a musician. If he's making some good money, he said he's thinking about maybe upping it to doing like $500 a month. So you just want to start finding clients of individuals. And last but not least, we have Thursday calls on this. We have multiple Thursday calls, and this is the website if you guys have not been in it. srstraining.com. I forgot I already took off the share. Family First Life switch from FFL AMS, and they're doing they made it simple. Instead of advanced market sales, they're doing Family First Life simple retirement solutions. Okay, you guys can do annuity training, you guys can do IUL training. That's basically the gist of it. But there's some killers out there. On last Tuesday when I was in Florida, one of the top guys, Juan Franco, who we had on our call, he's doing $100,000 in production just on IULs. And it's not even that bad because he's like doing 20 appointments, but he's making 8 sales, but each of his sales, his annual premiums, 8,000, 10,000. And he just goes in for the kill. What's a comfortable maximum budget that you can do on this life insurance, on your retirement? So he's going for the kill and saying, okay, you want to do 300. Some of our clients do 300, some 5, some do 1,000. Okay, you want to do 1,000? I can illustrate you what 1,000 will look like. Questions? We're good? So think about like business owners, family members with young kids. You could tell them, look, you're buying all these dumb toys anyways. You're putting a piggy bank on them anyways. And what are you doing with the piggy bank? Sometimes people give them gifts, they give them cash, and they don't do anything with it. And it's left alone on a piggy bank, literally, and it's just sitting cash. You can start funding that. And you could do annual too. So you could do a lump sum. Some people, they got like 30,000, 100,000, and they just front load it 3 to 5 years and let it sit there and leave it alone. And then it just grows untaxed, and they could take out cash value accumulation withdrawals from it at any given point in time. So think big, think about your resources. But the most important thing is knowing about it so you can start spreading the information. And the more we put it out there in social media and marketing, you're going to get more leads coming your way. And this is where we're going to move into, like, aside from buying leads, we're going to create our leads. So next call we're going to be on, the 2 o'clock call coming on right now. I'm going to be with Albert. We're going to talk about policy owner review and policy reviews for your own clients, and then asking them the right questions to get annuity sales. So we're going to keep on focusing on IULs and annuities. Catch you guys at 2 o'clock call. Later.